Central banks are betting big on digital currencies. Dozens of CBDC pilots are underway from China to Europe to the US. But here's the truth. They're already losing. Stablecoins like USDT and USDC are moving trillions of dollars on keys every year, while CBDCs are still stuck in test mode. This is the Stablecoin Supercycle, and it explains why CBDCs may fail before they even launch, while stablecoins quietly win the future of money. Welcome to Plugged In Crypto, where we break down ideas, charts, and news. Stablecoins started as simple tools to move dollars faster, but today, they've grown into a global financial force. In 2025, the total stablecoin market has passed $130 billion, with Tether and USDC controlling over 90%. These tokens are everywhere, in trading, DeFi, payments, and even in emerging markets where they've become lifelines against inflation. The scale is staggering. USDT alone processes more daily value than Visa. Combined, stablecoins settle trillions per year, quietly rivaling traditional payment networks. And unlike CBDCs, which are only available in pilot programs or closed systems, stablecoins are already global, open, and accessible to anyone with a smartphone. Governments know this. That's why they've spent years hyping central bank digital currencies. The idea sounds powerful: programmable money, issued by the state, fully under central bank control. China launched its digital yuan trials years ago. The European Central Bank has been testing its digital euro. The US has explored FedNow and retail CBDC models. On paper, CBDCs could give governments perfect oversight of money. But here's the catch. CBDCs face two huge problems: trust and adoption. First, trust. A CBDC is programmable government money. That means spending could be tracked, restricted, or even frozen. In China's trials, some versions of the digital yuan expired after a set date, forcing citizens to spend them. Imagine getting paid but being told your money expires in 3 months. In Europe and the US, privacy concerns dominate every CBDC discussion. People already distrust banks and governments with their data. Handing them complete control over how, when, and where you spend? That's a tough sell. Second, adoption. CBDCs require building new infrastructure, educating users, and competing with existing digital money systems. In most countries, credit cards, mobile payments, and even existing stablecoins are faster and more convenient. Why switch to a CBDC that feels like surveillance money when stablecoins already do the job better? Meanwhile, stablecoins have exploded in adoption. In Argentina, where inflation runs above 100%, families store savings in USDT instead of pesos. In Nigeria, where banks restrict cash withdrawals, USDT trading volumes hit record highs on peer-to-peer markets. Across Latin America, stablecoins are used daily for remittances, often moving money cheaper and faster than banks or Western Union. Institutions are following too. PayPal launched its own stablecoin. Visa and MasterCard are exploring settlement with USDC. DeFi protocols use stablecoins as collateral, powering lending and trading worth billions. The truth is simple. CBDCs are still experiments. Stablecoins are infrastructure. That's what we mean by the Stablecoin Supercycle. Once a technology crosses a threshold of adoption, momentum builds exponentially. The network effect of stablecoins is already here. Exchanges, apps, wallets, DeFi, they all speak the language of stablecoins. Every new user adds liquidity. Every new use case makes them harder to replace. So, what happens next? Let's look at 3 scenarios. Scenario 1. Stablecoins dominate outright. CBDCs either never launch at scale or fail to win public trust. Stablecoins like USDT and USDC keep scaling, becoming the de facto digital dollars of the world. They don't replace fiat, they just become the rails it runs on. In this world, private stablecoin issuers act like the offshore eurodollar system of the 20th century, critical to global finance, but outside central bank control. Scenario 2. Governments fight back. CBDCs roll out alongside heavy-handed regulation of stablecoins. Issuers face stricter audits, restrictions, or even bans. But here's the paradox. Even if regulators slow them down, the demand for digital dollars is too strong. Black markets and offshore versions will thrive, much like eurodollars did. CBDCs may find some adoption, but only in closed systems: payroll, subsidies, government payments, not in open global finance. Scenario 3. A hybrid world. CBDCs exist, but only at the core banking level, while stablecoins continue to dominate the retail and crypto layers. This may be the most realistic outcome. Governments get some control, Markets keep their flexibility, and users vote with their wallets, choosing stablecoins for speed and freedom, while CBDCs remain largely invisible. No matter which scenario plays out, the direction of travel is clear. Stablecoins are already winning. They're faster, more open, and more useful than CBDCs. They solve real problems for millions of people today, and they're backed by the strongest currency in the world, the US dollar, without requiring trust in a central bank's digital experiment. Supporters of CBDCs say they're inevitable, but inevitability doesn't equal adoption. Just ask the dozens of central banks still stuck in pilot mode years after announcing their projects. Meanwhile, stablecoins keep scaling quietly, processing trillions, and building the financial plumbing of Web3. Critics argue stablecoins are risky, unregulated, and dependent on private issuers, and that's true. Tether's opacity, USDC's banking dependencies, these are real vulnerabilities. But risk doesn't stop adoption. In fact, demand has only grown through crises, from the Terra collapse to US bank failures. People don't want promises of a CBDC someday. They want usable digital dollars today. The Stablecoin Supercycle isn't about whether CBDCs fail. It's about how stablecoins are already winning. They're programmable, borderless, and liquid. They've become the financial infrastructure for crypto, and they may become the financial infrastructure for the world. Please subscribe to stay plugged in.